ngizondile Good grade 12 learners, and welcome to today's accounting lesson. My name is Mr. Simbi, and this lesson is brought to you by the Gauteng Department of Education in collaboration with Cybono Discovery Center, and it is being broadcasted here by Pakama Research and Development Center. I do hope, learners, you were looking forward to this lesson, and I want you to have your calculators ready. Make sure you have somewhere to write. And if you have friends, please tell them that the lesson has already started. And I hope that you benefit and enjoy today's lesson. Today we're going to be focusing on financial statements, that is the company's financial statements. And I know already in your classes you have done your income statement, that is the statement of comprehensive income. You also have done the balance sheet, that is the statement of financial position. Some might not have done the cash flow statement, but today I'm going to introduce the cash flow statement. If you've already done it, then today's lesson is going to be very important because you will benefit from what I'm going to introduce today. So today's topic is the cash flow statement. My objectives today are very simple. I would want to speak of the purposes of a cash flow statement as well as the preparation of a cash flow statement together with the notes that relate to the cash flow statement. Okay, with that being said, what then is the purpose of preparing a cash flow statement? Why do we prepare a cash flow statement? Because if you prepare an income statement, you want to calculate the profit. The balance sheet is for you to know the financial position of the business. But with the cash flow statement, we prepared so that we can know the cash that is being generated by the business. That is your cash inflows as well as your cash outflows, how the business is utilizing its cash. So what we're going to be focusing on today is the inflows as well as the outflows, and then how these inflows and the outflows affect our cash balances at the end of the financial year. Now, it is important, grade 12 learners, that you come to an understanding of how cash is generated. Now, every business needs cash. That is the lifeblood of a business. Every business needs to have cash. Now, that cash needs to be generated. In this lesson, we'll be talking of how cash is generated, as well as how that generated cash is utilized. So we'll look at the cash being generated and how that cash which we have generated is then utilized in a business. You'll find, as you see on your screen, that if a business has generated cash, they will use that cash that they've generated to buy equipment, to buy things such as your stock, and even to pay employees. As you can see here, we have machinery that the business would have acquired, as you see over there. That is how the cash of a business is utilized. Okay, I want us to quickly move on now, and you see we're going to talk about where do we get the information to prepare a cash flow statement. Where do we get the information if we are to prepare a cash flow statement? Our first place to go to look for information is what we call the statement of comprehensive income, that is your income statement. So if we are going to prepare a cash flow statement, you must have the income statement in mind. And remember, you've already done this in your schools. The next thing that you need is your statement of financial position. In this place, we are going to be looking at your current assets, your current liabilities, and things such as SARS, income tax, shareholders for dividends, and then it is very important that you know your fixed assets as well as your fixed deposits. But more importantly, you need to know your ordinary share capital as well as your non-current liabilities. In today's lesson, I'm going to unpack and I'm going to show you how these things assist us in preparing our cash flow statement. Now, you will also need the following notes. You need your fixed asset note, that is your note number 3. And I know most of you guys do love this particular note. So you need your fixed asset note. You need your share capital note, that is your note number 7. Your retained income note, that is your note number 8. You will need to know these notes. And then it is important as well that you know where do we get our dividends? You need to know of the calculation for dividends. Now, the cash flow statement is split into three parts. In other words, if we are looking at a cash flow statement, you must in your mind think three parts, okay? And the three parts, it is your O, your I, and the F. Yes, your O, the I, and the F. In other words, if you're preparing your cash flow statement, you need to know your OIF, your O, your I, and the F. In other words, it has three parts which are broken down, which I'm going to explain today. The first part is your operating activities. These are the operations of the business, okay? That is your O. The I, it is the investing activities. Where is the business investing into, and what is happening to those investments? And then your financing activities. It is, where are we getting our finance from? Is it through shares or is it through loans? So that is very important. So you have three parts. That is your O, your I, and the F. That is your OIF. Now, it is now very important as I broke down those three parts. That is your O, as you can see here, your operating activities, your investing, and then your financing activities. Your operating activities are mainly talking about the profit motive. Okay, it is the core function of our business. What exactly is our core business? What is the core function that we are using to generate profit? That is your operating activities. And then your investing activities, now we are looking at what equipment are we acquiring for us to achieve the objective of generating our profit. In other words, here we're talking capital expansion. Then the last part, as I said earlier on, it is your financing activities. That is, how do we get the money to finance our objectives? And there are two main sources of finance, very important for you to get this. Two main sources of finance. The first source of finance is what we call own capital. Own capital, this is our own capital, all right? And then this is from the issue of shares. So own capital has to do with shares. And the second type of finance is from borrowed capital, all right? And this comes in the form of what we call loans. So remember that? Two sources of finance. Number one, own capital, which is through shares. Then the second one is when we borrow our capital. Then we borrow it from financial institutions. So we are talking about loans. Now, my dear learners, it is important now that we come to the actual format of a cash flow statement. Remember, I broke it down into three parts: O, I, and F, operating activities. That's the first part. And if you look here, you'll find that your operating activities, you have 80,000 on your operating activities. And then your investing activities, and then we invested, and our investment went up to 100,000. This is our investment, 100,000. And then we had a cash inflow on financing activities of 60,000. Now, I want to emphasize this aspect. Please, it is important that you get this. When we do cash flow statement, brackets are very important. Yes, brackets are very important, because when you put a bracket, it simply is telling us that there is a cash outflow. Cash outflow. When you have a bracket, you're talking about cash outflow. And if you don't put a bracket, it then means it is a cash inflow. Now, here is the challenge. If you don't put a bracket and yet it is a cash outflow, you're telling the examiner that I'm interpreting this as a cash inflow, then you will be marked wrong. So brackets are very, very important in the preparation of a cash flow statement. So as you can see here on our cash flow from investing activities, there is an outflow of 100,000. Hence, we have brackets. But if you look at the financing activities, we have an inflow, no brackets. So it is very important to be able to distinguish between your inflows and your outflows. And then once you say your 80,000, I want you to have a calculator with you there quickly. Please punch in 80,000. And then if you go to the investing now, with investing, there is bracket. So you're going to come and say minus 100,000. So you're going to subtract 100,000. And then, but if you now come to your financing activities, it's 60,000 with no bracket. That means you're going to say plus 60,000. Your calculator is automatically going to give you your 40,000, which is what you find here. And we call it the net change in cash and cash equivalents. Net change in cash and cash equivalents. Very important. Don't forget, brackets are very, very necessary. Now, the last two parts of the cash flow statement are the reason why we prepare the cash flow statement. We want to ascertain, we want to know our cash flow balances. How do we come to these balances? Then you're going to have cash and cash equivalents at the beginning of the year, all right, which is 10,000. And if you add this two, that is your 40 plus your 10, it should then give you your 50,000, which is cash and cash equivalents at the end of the year. It is important, boys and girls, to note that a positive total will assist the business with liquidity. All right. So remember, here we're dealing with cash, so we will also talk about liquidity. Very important. Okay. I want us to quickly move on now. The structure of our cash flow statement. All right. Now, there are four items under our operating activities. There are 4 items under our operating activities. The first one is our cash generated from operations. And you can see there, I've said note number 1. When we look at a cash flow statement, I want us to look at it the same way we would look at a balance sheet. If you look at a balance sheet, you would think of a puzzle that we are bringing together, but calculations have been done on the side through our notes. So when you look at a balance sheet, you think note number 3, you think note number 4, you think note number 5, you think note number 6, you also think note number 7, number 8, and note number 9. And these notes are then brought together to get a balance sheet or statement of financial position. It is the same scenario in this case when we prepare a cash flow statement. We will do calculations on the side and then we bring them to one place. Then we can have a cash flow statement. And one of the calculations we will do on the side is cash generated from operations. The cash generated from operations, which is our note number 1, is a very interesting note because it is related to the income statement. So I'm going to show you how we do that as well. Now, here is very important information. Of the 4 items that we have in our operating activities, let this be a standard rule. Let this be a standard rule that for your interest, you can see there is a word there. It's saying interest paid. Interest paid. So you have to think now, if interest is paid, is it cash inflow or cash outflow? Simple. If you have paid interest, paid means it is cash outflow. Thank you. So if it is cash outflow, there's something that I told you about outflows. You must always put brackets. Okay? Very important. Now, that means on your interest paid, before you even think of calculating or looking for the interest, you must have your bracket ready here. Interest paid, bracket. The next one is your taxation paid. How much did we pay over to SARS as tax? And if you think again, this is taxation paid, that means already you must have brackets. Even before you even calculate the taxation amount, get to the taxation amount, but in your mind already, you must think, if it's paid, I must have brackets. The third aspect is dividends paid to our shareholders. Now, with the dividends paid, it is very important that you also put your brackets even before you've done the calculation. All right. And then when you're done with the operating activities, we're going to come now to our investing activities. How is the business engaging in investments? The first area we can talk about in investing activities is your fixed assets. In other words, when you look at the investing activities, there are two main lines. It is your fixed assets and your financial investments. Already in your mind, you're thinking the top part of the balance sheet. Yes, exactly, the top part of your balance sheet. Now, when you think of the top part of your balance sheet, you are going to have your fixed tangible assets and you have your financial assets, which is your fixed deposit. Those two aspects are the ones that relate to our investing activities. All right, so the first thing is when we purchase fixed assets, a business that is investing has to invest in fixed assets. So the first aspect is when we purchase fixed assets. Already you can see once you're purchasing, there has to be a cash outflow. So once it's a purchase of fixed assets, here we're going to experience a cash outflow, which is seen by brackets. And then the next one is proceeds from the sale of fixed assets. We do sell fixed assets, okay? Already you know, as a disposal. So once we sell our tangible assets, we have cash inflow. So that aspect is not going to have brackets because it is cash inflow. Remember, outflow, brackets. Inflow, no bracket. Thank you. Let's go on to the next one, which is investments. Okay. Now, with investments, there will be two movements. It is either we are investing or the investment has matured. Okay. Two movements. We invest. Okay. It can be in a fixed deposit. If we invest in a fixed deposit, we consider it to be cash outflow because money is going out. But it comes to a time when the fixed deposit matures. If that particular investment is matured, what happens? The money is deposited into a business account. Once money is deposited into a business account, then we're having a cash inflow. All right? So there are two sides to our investments. All right. I want us to quickly now, dear learners, to look at our financing activities. Again, on financing activities, there are two aspects. So if I'm to summarize it, I would say on my investing activities, there's two aspects. All right? And aspect number one, it is your fixed assets. It is your fixed assets. But your fixed assets can be split into two. That is, number one, when you purchase. Number two, when you sell. That is the disposal. And then when you look at the next one, it is your investments. That is your fixed deposit. And with your fixed deposit, it's either you are investing or it has matured. It is either you're investing or the investment has matured. So it is two aspects, but multiplied by two, there are 4 parts. But in most cases, the examiner will bring 3 parts. That is 2 of the fixed assets and 1 side of the investment, that is your fixed deposit. Okay. And if you come with me now to the financing activities, in the financing activities, you also have 2 aspects. You also have 2 aspects in the financing. How do we finance the business? There's 2 aspects that we need to look at. And these 2 aspects have 2 sides to it. That is why you end up with a total of 4. But the examiner in most cases likes to bring 3. But you have to understand that there is 2 aspects, and each aspect is 2 sides, which brings the total to 4. Okay, let's look at it this way. Number 1, the first aspect is our shares. Okay, the first aspect is our shares. And with our shares, there's 2 things that can happen. We can either issue shares. Now you remember, you're thinking note number 7. Or we repurchase shares. Already I know you're thinking also note number 7. You've done this one. And then the next aspect is going to be your loans. Your loans. Okay, this is aspect number 2 with your loans. And with your loans, you have to understand there are 2 sides as well. When the bank gives us money as a loan, that's a cash inflow. You're correct. And then the other side to a loan is when we pay back that loan. Exactly. So when we look at a loan, we're looking at it from two sides. Number one, the money is coming to us. We're receiving a loan. Number two, we are paying back the money to the financial institution. It can be a bank. Therefore, it is repayment of loan. So you would have three, but as I said earlier on, in most exam papers, you would find three aspects. Okay. Now, when you've done all of that, you will now come to the bottom part of your cash flow statement, which is your net change in cash and cash equivalents. With the net change in cash and cash equivalents, we are now looking at your cash and cash equivalents at the beginning of the year and cash equivalents at the end of the year. I'm going to show you quickly how do we get all those figures practically so. Now, let's go back again. I want to emphasize this. Very important. Very, very important. In our operating activities, remember, cash flow, how many parts? Three parts. Of the three parts, it is your O, the I, and then the F, OIF. So the first part is your operating with how many parts? 4 parts. All right. With your 4 parts, here is part number 1, which is your cash generated from operations. Your cash generated from operations, it is normally an inflow. Okay. If the business is healthy in any case, it has to be a cash inflow. But I've already told you that your interest paid, the key word there is paid. Once it's paid, it becomes a cash outflow. Hence, you see your interest is on the outflow. Outflow means money is going out of the business. Money moves in two directions, either in or it moves out. Okay? When we pay income tax, here's the clue. Paid. When we pay income tax, my dear learners, cash is going out. Hence, we're talking about a cash outflow. And then lastly, when we pay dividends, dividends paid. When we pay dividends, definitely our cash is going out. Cash outflow. All right. I want you to grab your calculator. Please keep your calculator close to you. This is a simple note of note number 1. Note number 1. Because remember, I told you that if we are to do a cash flow statement, we will need what? We will need note number 1. So we are going to do our note number 1, which is cash generated from operations. The amount that we get from this note is what we then take to the construction of our cash flow statement. You're going to see in the next few minutes. All right. So the format is very simple. It's very simple. Number 1, we start with our net profit before tax. Net profit before tax. Obviously, you know this amount, you're getting it from the income statement. This, you're getting it from the income statement. Okay. This is your net profit before tax. But the examiner at times would give you net profit after tax. So you must be wise enough to see if I have net profit after tax, that means they've already subtracted income tax. If I need net profit before tax, I must add the income tax back to the net profit after tax for me to get net profit before tax. I'm going to do an activity to show you exactly that. And then the next thing we do is we add back depreciation. We add back depreciation. And this also is coming from your income statement. You would remember that in accounting we have what we call cash items and non-cash items. Non-cash items, these are items that can be in an income statement but does not have to do with the movement of cash. In other words, we do pay for director's fees, yes or no? Yes. We do pay for rent expense, yes or no? Yes. We do pay for advertisement, yes or no? Yes. But we don't pay for depreciation. Okay? Like we say, I'm making an EFT for depreciation. No, that does not happen. So that means depreciation is a non-cash item. Very important. Depreciation is a non-cash item. And if depreciation is a non-cash item, in this case, we're doing a cash flow statement. That means in my income statement, for me to arrive at the net profit before tax of 820, under my operating expenses, I subtracted a particular expense, and that expense is called depreciation. But it is a non-cash item. What do? When I come to this note, I add back that depreciation. So depreciation is added in this note mainly because it is a non-cash expense. So I add it back to my net profit before tax. And the next item that I add back is what we call interest expense. Reason being, the interest is going to be shown on the face of the cash flow statement. It's going to be shown in the face of the cash flow statement. So I add it back so that I can show it on my cash flow statement properly. And if I say my 820 plus my 50 plus my 12,000, I'm adding these three figures. It should then give me my 882,000, which is what I call operating profit before changes in working capital. Operating profit before changes in working capital. Terminology is very important. You need to know the format of this thing. With your eyes closed, you need to picture it, you need to see it. Perfectly so. And the next aspect then becomes my changes in working capital. My changes in working capital. And my changes in working capital, dear learners, has three parts to it. Three. Okay? Number one, I'm going to talk about my trading inventory. In other words, I'm going to look at my note number 4. And then I'm going to talk about my trade and other receivables. And then means I'm going to look at note number 5. And then my trade and other payables, that means I'm looking at note number 9. You need to know these notes by heart. So, when I look at my inventory, I'm looking whether inventory has increased or decreased. I'm going to emphasize that in the activity. I want you to stay tuned. And then I'm going to look also in my receivables. Is it increasing? Is it decreasing? And then I'll also look in my payables. Is it increasing or decreasing? I'm going to explain this as I do my activity. And if you say 20,000, which is a negative, you add the 30 and then you subtract the 40, which is also a negative, you're going to end up with your 30,000 there. And when you say your 882, you subtract the 30,000, which is negative, then you have what we call cash generated from operations. Once you have this, you are now one step into the cash flow statement, because this is what we need when we prepare a cash flow statement. Dear learners, I want you to come with me now. I'm going to do activity number 1. Here is activity number 1. It is a reconciliation between net profit before tax and cash generated from operations. Please keep your calculators close. All right, let's see. What do they give us here? The first thing we are given is net profit after tax. Okay? So here the examiner is trying to check with us. Do we know the difference between net profit before tax and net profit after tax? Yes, we know the difference. What is the difference? Income tax. Okay? In your mind, you must picture the income statement already. That income tax in the middle. Now, if they've given us net profit after tax, yet we want net profit before tax, that means we have to add something back. I want to show you how to do that. Okay, so what you do, you come here now, you're going to say my net profit after tax, which is 555,500. But I need before tax, that means I'm going to come here and add my income tax, which is 394,000. When I add those two figures, already on a calculator you can see, you're going to have what we call 949,500. You've shown the examiner, I know the difference between net profit before tax and net profit after tax. Here I wanted before tax, so I add income tax back to net profit after tax. And then adjustments in respect of, number 1, interest paid. Remember, I told you these two, you are adding them back. You're adding them back. Okay? Interest paid. You're going to come and take your interest on loan here, which is your 252,000. So I'm going to come here. Interest paid is 252,000. I'm adding it. I'm adding it back so that I can show it properly on the face of the cash flow statement. And the next one I'm going to add back is my depreciation. And reason being that I'm adding it back, you remember? Exactly. It is a non-cash item. So I'm going to add back my depreciation, which is 453,000. Okay, I want you to punch in those figures. You should find an amount. So I'm adding these three figures here. And then you should then get your 1,654,500. Okay, and this is your operating profit before changes in working capital, 1,654,500. Let's go on now. I'm continuing. So remember, this is what we got from the previous calculations. Okay, I'm continuing. And I am now going to look into the three aspects. Number one, I have my increase or decrease in inventory, which is here. I have my increase or decrease in trade and other receivables, which is here. And lastly, I have an increase or a decrease in trade and other payables, which you see here. Let me start with the first one, which is my inventories. Remember, inventory is note number 4. When you look at inventory, inventory moves, okay? When inventory is stagnant in a business, it is a major concern for the business owner. Inventory has to move. And inventory moves in two ways, two directions, okay? It is either in or it moves out. Let me repeat that again. Inventory moves in two ways. It either moves in to the business or it moves out. But in this particular case, we are not much concerned about inventory. We are concerned about the relationship between inventory and cash. We know that when inventory moves in, it never moves in the same direction with cash. In other words, when inventory moves in, cash moves out. Let's repeat that again. When stock is moving in, inventory moving in, that means we're buying stock, we're purchasing. And when we purchase, cash has to move out, paying creditors. And our main concern is not on the inventory, but on the cash aspect of it. Why? We're preparing a cash flow statement. So let's look at this again. If inventory is going out, what are we doing? We are selling. Inventory is going out. We are selling. So if inventory is going out, cash is not going to go out at the same time. Cash has to come in. We are selling. Inventory goes out. Cash comes in. We're looking at cash inflow. Very correct. So you need to look at those things there. Okay. So let's look here. We are given the year 2020 and we're given the year 2021. These are two separate years, 2020 and 2021. If I look at my inventory, what is happening here? In 2020, I have 272,000. But in 2021, I have 254,000. That means I have a decrease. I have a decrease in inventory. My inventory has decreased from 272 to 254. That means inventory is going out. And once inventory goes out, it's a cash inflow. Out, going inventory, in comes cash. Cash inflow. All right. So in other words, I'm going to come here and I'm going to do my calculation. I'm now going to say 272,000. This is my 272,000 minus the 254,000. And then the difference between those two figures should then give me 18,000. Okay. How do I know it's a cash inflow? Simple. There's a decrease in inventory. But I know most of you guys love your calculators. You love your calculators. And I want to give you what I call the calculator method, or the I trust my calculator method. Let's use the I trust my calculator method. When you're using the I trust my calculator method, you come here, you are now comparing between, first you have to focus on assets. You have to think, is inventory an asset or a liability? That's given, guys. Inventory is your asset. So if inventory is an asset, I'm now going to say, when I say my previous year, that is the year 2020. The previous year is the year 2020. And the current year is the year 2021. So I'm not going to put the figures. I'm just going to say previous minus current. And whatever figure the calculator gives me, I trust my calculator. I take the figure that the calculator gives me. Okay? So I'm going to say in the year 2020, which is my previous year, how much was it? It was 272,000. So I'm going to come here and I'm going to say 272,000. In my current year, it is 254,000. If you punch that in the calculator is going to give you a positive 18,000, which shows an inflow. Okay, let's go on to the next one. The next aspect is trade and other receivables. When you think trade and other receivables, the first thing that comes to mind is trade debtors, businesses and individuals who owe our business. Then there will be two things that you look at. Number one, either an increase or a decrease. Either an increase or a decrease. Let's explain an increase. What does it mean? If there's an increase in trade and other receivables, these are your debtors. If debtors are increasing, it means they're not paying you. Yes. If your debtors keep increasing, it means they're not paying you. And the moment debtors don't pay, we consider it to be a cash outflow. Okay? So an increase, we consider it to be a cash outflow. There. But if your debtors are decreasing, what does that mean? They are paying. If your debtors keep decreasing, those debtors are paying you. And once debtors pay us, we call it a cash inflow. Okay? So you can choose, you can use this explanation that I've said, or I trust my calculator. With I trust my calculator, what do you say? You say previous minus current, and the calculator would automatically give you the right figure. Let's see that now. What is my previous amount? My previous amount is 770,000. So I'm going to come here, I'm going to say 770,000. What is my current? Trade and other receivables, 1,638,000. Punch that in your calculator. If you punch that in your calculator, you should get an amount which is 868,000. And if I ask you, on the calculator, does it have a minus sign in front of the figure? Yes. Once it is a minus sign in front of the figure, that means it is a outflow. That means I must have bracket here already. I must have bracket. And then I'm going to put my 868,000. Okay? Why? Because my debtors were 770. Now my debtors are 1,638,000. Debtors are not paying me. And when they are not paying me, I consider it a cash outflow. Or I trust my calculator. Previous, 770,000. Current, 1,638,000. And the calculator tells me the amount is 868. But not only that, it is a negative. So I put a bracket. Bracket means it is an outflow. Okay, awesome. Let's come now to the last aspect of my changes in working capital. I want you to look at this one now, which is an increase or a decrease in trade and other payables. When you think payables, what comes first to your mind? Creditors. What are these? Businesses and individuals whom our business owe money. We owe them money. So two things are likely to happen. If our creditors are increasing, that means we are not paying. If we are not paying, we consider it a cash inflow. I'll repeat that again. Creditors, businesses and individuals, we owe them money. If our creditors are increasing, that means we are not paying them. And if we don't pay them, we consider it to be a cash inflow. And the opposite therefore becomes true, that if our creditors are decreasing, why would creditors decrease? Because we're paying them. And once we pay, cash is going out. So a decrease becomes an outflow, yet an increase becomes an inflow. Okay. All right. Let's come and look at this. In the year 2020, we had 692,500. Here we are. And in the year 2021, we had 479,500. There we are. Then that means there is a decrease. So in your mind already, you know if creditors are decreasing. I have paid, yes. And if I have paid, is it inflow, outflow? I have paid. Remember the word paid. Paid means what? Outflow. Brilliant. Or I can use the I trust my calculator method. But this is no longer an asset. This is now a liability. Remember, it falls under current liabilities. So if this is now a liability, what then will I be saying? I'll be saying current minus previous. Current minus previous. How much is my current? My current is the year 2021. So my current is the year 2021, and I have 479,500. Let me look at my previous, 2020, the previous year. And my previous is 692,500. 692,500. Therefore, it should give me a figure. How much did you get on your calculators? Punch it nicely. You should get an amount which is 213,000. But if you look again in front of the figure, what do you see? A minus sign. A minus sign means it is a cash outflow, a negative. So your calculator gives you the figure straight on. It gives it to you straight on. Okay? So I have my outflow here. Outflow is shown by the bracket. Now, when I have these three aspects now, I then need to get what we call my changes in working capital. So, have your calculator, guys. Have your calculator. I'm not going to say 18,000, which is a positive 18,000. And then you say minus 868,000, because it is in bracket. Minus 868,000. Then I also come and say minus 213,000. In your calculator, you should get an amount. Okay, how much are you getting on your calculator? You're getting a total of 1, okay, it's a negative, very important, a negative 1,063,000. A negative 1,063,000. A negative 1,063,000. Then you now say your 1 million, your operating profit before changes in working capital, which was 1,654,000, okay, and then you subtract 1,063,000, okay. So remember, this one is not in brackets. We did it earlier on. It is not in brackets. And then you are saying this is a positive 1,654,500. Then you subtract your 1,063,000, which we just got now. It should then give you an amount at the end. Okay, punch that in your calculator. How much do you get? You should get an amount of 591,500. 591,500. This is what we call cash generated from operations. We take this quickly to the cash flow statement. This goes with us straight to the face of the cash flow statement. Straight to the face of the cash flow statement. Okay, how did we get 591,500? I'll repeat again. We have a positive 1,654,500, which is coming from the previous calculation, and then we now have a 1,063,000, which is in brackets. So you get the difference between these two particular figures. You end up with 591,500. Let's see now where that is going to appear. Okay. So this is the complete version of it. Here is my net profit. Remember that calculation, and you have this one. And remember, I added this 2, and then I got my 1,063,000. 654,500. And then I subtracted my 1,063,000, which was an addition of this 3. And then I come up with 591,500, which will then appear in my cash flow statement under my cash generated from operations, which is 591,500 over here. Not up there, it should appear down here with my 591,500. Cash generated from operations, 591,500. Cash generated from operations. Okay, let's quickly go on now to this activity. I've pulled this activity from the DBE prelim the year 2021. This I pulled from the DBE prelim of the year 2021. All right, now the first thing that they want us to do is to prepare a cash flow statement. Now, remember note number 1, they've already done it for us. Here is my note number 1. They've already done it for us. So I'm not going to stress about that. I'm going to stress about the cash flow statement itself. And the first thing is interest paid. Where's my keyword? Paid. Once I hear the word paid, what comes to mind? In my mind, I think bracket. Before I even put the figure, this word paid means I must put brackets. And then I come to my income statement. I'm just going to take the same figure and I'm going to bring it all the way here. The one from the income statement, i.e. interest expense, and it is 126,000. There you go. 126,000. Brackets, very, very important. Brackets, very, very important. I'm going to come to the next aspect, which has to do with dividends. Dividends. You do understand that when we have shareholders, we need to pay them dividends. All right? So far I have this one from the previous activity. I also have the 126, but here I need dividends. What is the keyword? Paid. Paid means what? Brackets. Even before I calculate my dividends. Now, this is what I want you to do. I want you to think, how many times do we pay dividends? Or what are the 2 types of dividends? You're correct. We have what we call the interim dividends, which are paid during the financial year. And then there's the second one, which is called the final dividends, which is only declared, however, paid in the next financial period. Interim and final dividends. Now, I want to open a quick T account, and I want you to come with me. I want you to come with me as I open this quick T account. I'm going to open an account which I'm going to call my dividends account. All right? I'm going to come here and I'm going to call it my dividends account. All right. So, the first thing that you have to think is, this is my extract of the balance sheet. All right? You can see here shareholders for dividends. Once it says shareholders for dividends, these are my final dividends. These are final dividends. Shareholders for dividends. So I'm going to come to my account and I'm going to say I have my balance brought down here. In my balance, at the beginning, I have 160,000. That is my shareholders for dividends from the previous year. And in this year, I'm now going to say, how much do I owe at the end of this financial year? Remember, they are only declared and they're paid in the next financial year. How much is my balance? I'm going to come here and I'm going to say my balance brought down is 120,000. But you guys know already that it cannot just be brought down here. It has to be carried down here. So I'm going to come here and I'm going to have my balance carried down, which is 120,000. I'm then going to come here. I'm going to say I need what? Ordinary share dividends. ordinary share dividends is made up of two. Number one, interim and final. Interim and final. I already have the final, the 120. So I'm going to come here. I'm going to have my 120,000 here. So the only thing I need now is my interim dividends. I need my interim dividends. Let us hear what the information says. On 1 March, the ordinary share capital comprised of 800,000. That means we had 800,000 on 1 March. And a further 200,000 shares were issued on this date. In other words, we issued 200,000 more shares. And then we had 1 million. On 29 February is the last day of the financial year. The company repurchased. So we are not looking at the last day of the financial year because interim are paid during the financial year. So during the financial year, how many shares were we having? We're having 1 million. Why 1 million? Because the repurchase only happened on the last day of the financial year. So during the year, we had 1 million. If we're going to declare interim dividends, we declare them on the 1 million. So I have 1 million shares. What was my interim dividend? I am not going to look at the 2019 one. I'm going to look at the 2021, which is 28 cents. So I'm going to say 1 million multiplied by my 28 cents. On your calculator, you should then get 280,000. That becomes your interim dividends. So I'm going to come here and I'm going to say plus 280,000. That's my interim dividend. Okay. Once I am doing this part, I think already you can see note number 8 in your mind. You're thinking note number 8. Interim, which is paid. Final, which is declared. Already you can see that. You can picture that. So I have my 280 here and I have my 120 here. If I add those two, I should then get my 400,000. I should get my 400,000. When I have my 400,000, then I say 160, which is what I have at the beginning, plus the 400,000. If I add this two, it should then give me 560. Remember, I'm completing a ledger account. So I look for the side with the highest amount. Here it's 560. That means the missing amount here becomes my bank. That is the missing amount. How do I get that? I'm saying 560 minus 120. 560 minus 120, which then gives me 440,000. That is the dividends paid. 440,000. 440,000. Dividends paid. But there is another quicker way which you could do. And I know some of you have not been taught the ledger account, you have been taught the note, which is very super. But there's another quicker way which you can do in the twinkling of an eye. That method, you will simply say, last year's final. What was last year's final dividend? Because it was never paid last year. It will only be paid this year. And what we want is what is being paid. What is last year's final dividend? Last year's final dividend was 160. Here it is. Last year's final, 160. And what is this year's interim dividend? We calculated it, remember, 280. So, this year's interim. Last year's final plus this year's interim. 160 plus 280 will give you your 440. This would be the quickest way to calculate your dividends paid. All right. In other words, for me to get that 440 there, I can simply open a bracket and I'm simply going to say 160,000 plus my 280,000, which gives me my 440. All right. I know you got that one. Let me quickly move on, boys and girls, to my next aspect. My next aspect is very interesting. I call it taxation paid. Taxation paid. I'm also going to open what I call my tax account. Okay, you have done the SARS income tax in term 1, and then I'm just going to use the basic principles that you were taught in class. Remember, 2019 is the opening balance, 2020 is the closing balance for this financial year. And in 2019, the balance is credit. Remember, this is my credit side and this is my debit side. So I'm now saying in my SARS income tax, this bank is cast in stone. It doesn't move. It must always be on the debit. It's cast in stone. It doesn't move. Okay. And then I'm going to start off with my opening balance. So I'm going to come here. I'm going to say, where's my balance brought down? My balance brought down is 23,800. But I have my closing balance, which is debit. Debit, this is my debit side. And if it's in the balance sheet, it is not balance CD, but balance BD once it's in the balance sheet. That means I'm going to come here. I'm now going to say balance brought down. Here it's going to be 4,500. Already you know, you must have a balance carried down. That means I'm going to come here. I'm going to say balance carried down, which is again 4.5. My last item, which is also cast in stone, never to be moved, is my income tax for the year. And my income tax is 415,200. So I'm going to come here. I have my 415,200. 415,200. And since there is nothing on my debit side, I'm just going to add my credit side. And if I totalize my credit side, I should get a total of 443,500. Here it's 443,500. Therefore, the debit side should also have my 443,500. That becomes my bank. Bank is speaking to the cash flow statement. Very simple. I know. Very simple. Let's quickly see where would this then be recorded. I come here. Remember we did that, and we did that. I'm coming now to my taxation paid, and how much did I get? Remember, before I put anything, the keyword is paid. That means I'm going to have my bracket, and I'm going to bring my 443,500. Okay, once I have my 4 aspects of my operating activities, I have all 4 aspects, what does that mean? It means I can add them for me to now get the cash effect of operating activities. So quickly now, with your calculator, you are now saying 1,623,000, which is the first one here. Then you have a negative 126,000. It's a negative 126. Then you have a negative 440. You have a negative 440. And you have a negative 443,500. You have a negative 443,500. It should then give you 613,500. It should give you 613,500. That becomes your cash effects of operating activities. Now, here is how it will appear. Here is your 613,500 because of these 4 aspects. Remember, we did the or. How many parts to a cash flow statement? O, I, F. We've done the O. Let's quickly move on to the I. The I has to do with investments. And the first aspect or the first port of call in terms of investments is your tangible assets. And then let's see, there are 2 things that happen with tangible assets. We buy the assets or we dispose of the assets we're selling. Several reasons why we dispose an asset. I'm not going to get into those ones now. So, there are 2 ways in which you can do this. You can stick to note number 3. You remember note number 3. Okay? There is the note number 3 method, of which you can do it on the note itself. And the second method, which I prefer, which is very much easy, is you open a fixed asset account, but it is at book value or at carrying book value. So we are not looking at the cost of the asset, but we're looking at the book value of the asset. Now, if you're using this method, you start off with a balance at the beginning. And the balance at the beginning here is your 8,320,300. So I'm going to bring it here. It's my 8,320,300. That is my opening balance. Asset disposal. That means, did I dispose of any asset during the financial year? They should have told us. Old equipment was sold at carrying value 48. That means I bring my 48,000 here. Depreciation. Why would depreciation come into this account? Because this is a fixed asset account at book value. If it was at cost, depreciation must never be seen in here. But because it is at carrying book value, I can bring in my depreciation. And my depreciation is 234,000. That is my depreciation. Okay? And then, do I have a closing balance? Here it is, given. 9,528,300. So first it becomes my balance carried down, 9,528,300, which when I come down here, it is my balance brought down, 9,528,300. Okay, so I'm gonna, because the credit side is bigger, so I'm gonna add my credit side. And after adding my credit side, I want you guys to tell me how much do you get. You should get your 9,810,300, which I will also bring now to my debit side. 9,810,300. Therefore, the missing amount here becomes bank, which is now speaking to the tangible assets which we have acquired. And if you punch in your figures, you're simply saying now your 9,810,300 minus your 8,320,300, and it should give you 1,490,000. 1,490,000. That then speaks straight onto the fixed assets purchased. But I want you to see two things here. I have my fixed assets purchased, which is here, number one, the 1,490,000. Number two, I have the proceeds from the sale of asset. So from this account, I'll come out with two figures which are required for my cash flow. Number one, what I've used to acquire assets. Number two, what I have received from the assets that I have disposed. I want you to see now, when we come here, I'm now saying my fixed assets purchased. Remember, purchased means cash outflow. So I'm going to have my 1,490,000. But at the same time, I've sold an asset for 48,000. Should I put a bracket? Absolutely no, because it is a cash inflow. And why do I have bracket here? It is a cash outflow. I have acquired some assets. Okay? Now, here it is. Very well written. The next aspect now has to do with financial assets, our fixed deposit, our investments. Now, we are looking at either there is an increase or a decrease. Let's look at it here. In the year 2019, our fixed deposit was 500,000. In 2019, the previous year, we had 500,000 at the bank as an investment. But in this year, we don't have 500,000 anymore. We now have 100,000. There is a decrease in our investment. What does that mean? It means the fixed deposit has matured. Already you understand. When a fixed deposit matures, yes, it becomes part of our cash. So we have a cash inflow, all right? A fixed deposit which has matured. So we have a decrease in fixed deposits. What am I saying here if I'm to show calculations? If I'm to show calculations, I'm coming here to say, I'm going to show it down here. I'm saying my 500,000, which is what I had at the beginning, minus the 100,000, which means I have 400,000, which is my cash inflow. Cash inflow. It has matured. And I told you on your investing activities, there are two aspects, which is your tangible assets and your financial aspects. Your tangible assets, they can bring you 1 and 2. But with your financial assets, that is the fixed deposit, they normally would bring you one side to it. But your tangible assets, they'll have to bring two sides to it. So here you only have one side to it. That means my investing activities are completed. So Have your calculator close to you. You're going to say now 1,490,000 negative, remember. So minus 1,490,000 plus your 48,000 plus your 400,000. You should then get your 1,042,000. You should get your 1,042,000. Okay, are we still cool? Thank you. Let's quickly go and see how it would appear now. How would it appear? If I am to show you the cash flow statement, remember we've done how many parts so far? 2. The O and the I. Okay? Cash effects from operating activities, we sorted. Then now we are sorted with cash effects from investing activities. So we are sorted with 2 parts so far. How many parts are left? 1. Which one is it? Remember? O, I, F. We're now left with the financing. Okay, let's quickly go. Do you still remember what I said about financing? 2 aspects as well. You remember which ones? Shares and loans. Thank you. Let's quickly go. Let's quickly go now to our financing activities. The information that we have here is pertaining now to our shares. Let's hear what they are saying. They are saying there's an extract of the balance sheet, and then we have information which is relating now to the issue of shares. Now, I'm going to write, then I'm going to go on to the next slide. I want to show you something. If I want to do this, the quickest or the easiest way, anything to do with shares, I have to open my note number 7. Okay? So I'm not going to make it so formal, but I'm just going to open my note number 7. Let's say this is my note here. Okay? Now, here is my ordinary share capital. Do not make a mistake of using the shareholders' equity. Here's the shareholders' equity. Don't make a mistake of using these figures here. You must use the ordinary share capital. So, I have my balance at the beginning, which is 7 million here, 200,000. Okay? Remember, I'm not using that. I'm using this one, 7,200,000. That is my balance at the beginning. But my balance at the end is 8,281,000. 8,281,000. This is my balance at the end. Let me now hear what they're saying in the other information. On 1 March 2019, I'm reading over here now, the ordinary share capital comprised of 800,000. In other words, here I had 800,000 here. 1 March, that is the beginning of the financial year. And then they say a further 200,000 shares were issued. So here I have 200,000 shares here, which are being issued. Okay? These are issued. At what price did they issue them? They never told me. Should I stress? No. In accounting, here's one principle. If you're not given the figure, they want you to find out the figure. So don't stay in that place. Continue moving. Let me move on and see where else do I go. Then they say to me that on 29 February is the last day of the financial year now, the company repurchased 90,000 shares. So I'm coming here now to say minus 90,000 shares. All right? I'm repurchasing 90,000 shares. If you were to do figures here, you should then get 910,000 here. Okay? Now, they then say, these shares were repurchased at 81,000 above the value of the shares. Once they begin to talk about above, in your class, you should have done the triangle. Okay? The triangle is 3 parts. The first one is the repurchase price. Okay? Then here you have the average price. And here you have the difference. So when they say they repurchased at 81,000 above, they're talking of the difference, which is your 81,000. But we repurchased them at above 81,000. And how many did we repurchase? We repurchased 90,000. So what was the price per share that we paid above? It is 90 cents. So here the difference is going to be 0.90. 90 cents. We paid 90 cents per share above the average price. That's what they're telling us. About the average price of, and then they give us the average price. Here's the average price, which is 9 Rand 10. And in here, average price 9 Rand 10. And the repurchase price is the total of these two. 9.10 plus 90 cents gives you 10 Rand. This one goes to note number 7. This one goes to note number 8. And this one goes to the cash flow statement. So what am I doing here? I'm doing note number 7. That means I'm going to take the 9 Rand 10 cents. So I'm going to come and say these are repurchased at 9 Rand 10 cents. Already, if there's a repurchase, I must keep my brackets open already. If you now say 90,000 multiplied by 9 Rand 10 cents, if you multiply those two, you should get 819,000. You should get 819,000. Okay? 819,000. And then you then say, but I still don't have this figure. I still don't have this one. Which leads me to get that one. It's not a problem anymore. You simply now use your calculator. I want you to have a calculator close to you. Clear everything off it. Then punch in the figures I'm going to give you now. Number 1, you say your 8,281,000, which is this one here. You're going up, so you do opposite of the sign. 8,281,000 plus 819,000. You're adding the 819,000. Then you say minus the 7.2 million. You subtract the 7.2 million. I'll repeat again. 8,281,000 plus 819,000 minus 7.2 million. And it should then give you 1,900,000. 1,900,000. This is what we got when we issued shares. 1,900,000. So from here, I have two amounts that I need. Number 1, how much is it that I received from the issue of shares? 1.9 million. Number 2, how much did I pay on the repurchase of shares, which is 10 Rand per share? Let's see. How then do I show this in my cash flow statement? Proceeds from the issue of shares. Remember, how many shares did I sell? I sold 200,000 shares, but how much did I get? I got my 1,900,000. Do I consider that to be inflow or outflow? Proceeds from issue of shares. We gave them shares. They gave us the money. Cash, inflow. You're correct. Funds used to repurchase. Once you are buying back, it will be a cash outflow. We're buying back shares. It becomes a cash outflow. How many shares did we buy back? The question told us. We bought back 90,000 shares. Do you still remember? We had 3 amounts on the triangle. We had 3 amounts on the triangle. We had our 10 Rand. Okay? We had our 9 Rand 10 cents. And we had our 90 cents. And I told you this is what goes to the cash flow statement. This goes to note number 7. And this goes to note number 8. So here I'm going to bring my 10 Rand. Okay? And then I'm now going to get my 900,000. My 900,000. All right. I want us to quickly go on and you will see how it appears now. Here we are. And then the last aspect, remember, in your financing activities, how many aspects? 2, which is shares, but shares how many sides? 2. The next one you have is loans, and loans has how many sides? 2. So far we have the 2 sides, which is this one. 1, 2. But with the loans, the examiner would also likely to bring one side. Okay, let's see what they brought in the 2021 paper. In this paper, you see that we had a loan of 1,200,000 in 2019. But when we go to 2020, the loan is no longer 1.2 million. The loan is now 900,000. That only means one thing. Our loan is decreasing. And the reason why a loan would decrease is when we pay back the loan. So here, there's a repayment of the loan from 1.2 to 900,000. All right? And then that is what you see here now. Loan repayment, it was 1.2 million, but we have paid 300,000 because now we are left with 900,000. It was 1.2, now it's 900. That means we've paid 300,000. It must be in brackets because it has been repaid. Now, we have the three aspects so far of our financing activities. Once we have the three aspects, we then add them up for us to arrive at our cash effects on financing activities. We add them up. Please have your calculator close to you. You're now going to punch in, and here are the figures that I want you to punch in. 1,900,000 minus 900,000 minus 300,000. So you subtract the 900 and the 300 from the 1.9, and then you should then get an amount of 700,000. Okay, 700,000. Okay, very simple, very simple. Let's see now when it is now shown in a cash flow statement. So remember, we did my O, we got 613,500. We did my I, and I had my 1,042,000. Very important, very important. I'm now looking at the totals, the ones in green, okay? And then we did my financing, which is your 700,000. Now, you will then now have your calculator, very important too. You will now say, I need now to get what we call net change in cash and cash equivalents. How do I get that? Let's go. Punch in the green figures only. The green figures are the ones that will give us the red figure here at the bottom. The green figures will give us the red figure at the bottom. So the first one is 613,500. Then you come to the investing activities, 1,042,000. Remember, that's a minus now. So on your calculator, you must say 613,500, then minus 1,042,000. That's a minus 1,042,000. Then you will now say plus, because the 700,000 does not have a bracket. That's a cash inflow. Plus 700,000. Your calculator should then give you an amount of 271,500. 271,500. You will get this right from your calculator. 613,500 minus 1,042,000, okay? And then you say plus 700,000. You get 271,500. Okay, let's quickly see. You will realize that we are not yet finished with the cash flow statement, because what we have now is just the net change in cash and cash equivalents. Here is a very important aspect which the examiner loves to test. Remember that 271,500 which we calculated. It is here. This is the last part of the cash flow statement. And I tell you the truth, examiners love this aspect here. They love it so much, especially when it comes with a bank overdraft. They love to test candidates on how they treat this bank overdraft. So you must listen attentively in this part now. Now, after my net change in cash and cash equivalents, I must have cash. Here I'm going to have my cash, and I'm going to say opening balance. And here is my cash closing balance. Okay, you see others will say cash and cash equivalents at the beginning. and also cash and cash equivalents at the end. Okay? Now, if I come here, which one is my beginning? Not beginning. It is my 2019. That becomes my opening. Okay? And my 2020 becomes my closing. Okay. So in my 2019, I have a positive 5,000 because it is under my cash and cash equivalents. Cash and cash equivalents, these are my assets, under my current assets. So this is a positive 5,000. A positive 5,000. That means I must open a bracket here now. And I say I have 5,000. But I also have a bank overdraft of 220,000. A bank overdraft means minus. So if I have a bank overdraft of 220, I'm coming here now to say 5,000 minus 220,000. Okay? It's my 5,000 minus 220,000. If you punch that in on your calculator should then give you an amount which is a negative 215,000. That's a negative 215,000. How do you get that? It's a 5,000 minus 220,000 that gives you a negative 215. I've seen others would start with minus 220 plus 5,000. It still would give you the same figure. It will still give you a negative 215,000. Okay? And then you then get your cash closing balance, and your cash closing balance, you are taking your cash and cash equivalents at the end, which is your 56.5. So you're coming here to say, here's my 56.5, which is my cash closing balance, 56,500, which is given here as well. Now, I want us to see how it will then appear when it is a full cash flow statement. Remember again, your O, your I, your F. We add that, and it gives us our 271,500. And then I showed you how to get the 215, and then you end up with your 56,500. When you've done this, your cash flow statement is complete. Now, dear learners, I must emphasize the issue of brackets. In the cash flow statement, no bracket means inflow. And if the examiner wants an outflow, you don't put brackets. You're telling the examiner this is an inflow, and therefore you will not be awarded a mark. I want to emphasize that. And once more, remember, your cash flow statement is broken into the O, the I, and the F. And when all these three parts are added up together, it then comes up to your net change in cash and cash equivalents, and then you close it off your cash flow statement right at the bottom. Okay, I do believe that you have enjoyed today's lesson, and you have benefited from the cash flow statement. And I think the next presentation is going to be exciting as well. So please continue to look for the link as soon as we come to our next lesson, which is going to be very interesting. I want to thank you for watching this lesson. Please remember to sanitize, wear your mask, and maintain social distancing, and keep yourself safe. And until next time, continue calculating. My name is Mr. Simbi. Until next time, cheers and bye-bye.